Hey traders, hey YouTube, hey to my subscribers, hey to my COT Academy fam, hey to everyone. Hope you guys having a wonderful trading week. And I pray that you're using this week to prepare yourselves for the next trading week. That's your boy Harlem, King COT, and we're back with another video. So today's video, so today's video, I want to share with you guys how you have to spot out, or let me just say, the equivalent risk reward ratio you have to use when trading currency pairs and why you have to use it based on trading sessions, right? So this video that I'm about to share with you guys is something not different, but it's more educational and more aligning with your education and your knowledge in your trading journey, because many traders come to the markets with a belief that they want to have a 1 to 10 risk reward, a 1 to 15, a 1 to 50, which is not wrong. But how do you often win trades with your 1 to 10 or 1 to 15, right? Real traders, or let me just say great traders, use the simplest approach: 1 to 1, 1 to 2, 1 to 3, right? Even 1 to 4 and even 1 to 5. But the main ones are 1 to 1, 1 to 2, 1 to 3, right? So before we get any further with the video, make sure you like on the video, you subscribe to the channel, you share the video, you comment on the video, you click the link to sign up with the broker that I trade with and highly recommend. Or if you want to be part of our COT Academy team, we're having 3 exclusive mentorship services. You can choose which do you prefer and which do you want to work with, and let COT Academy do the rest from there. But without further ado, let me share this wonderful chance and let me grow your knowledge and let me make you guys great traders like you're destined to be. Right. So on this trade breakdown, you can clearly understand that price had this lowest point, USD CAD, right? So price at this lowest point from this highest point that we printed out. And once we printed out this low, price came back and printed a high, came back to print out a low, and then some type of highs, and then again a low, and then some type of highs, and then price did what? Price clearly shot to the downside. But before we get here, I want to make you guys understand a few things, right? That USD CAD had this low printed out, right? And had this high printed out. And from having this high printed out, you can clearly see that price had some type of reaction. The first reaction, the second reaction, and third reaction, but didn't fully touch the very same zone, right? And what happened from there, you can clearly see price started pushing to the downside. So yesterday, when I showed up to the team, I told my COT Academy subscribers that, guys, price is possibly looking to be bearish, right? So it starts here. Price is bearish. We can see we have a clean move to the downside. Two, we can tell that price has printed out this lower low. Three, we're possibly waiting for price to give us a confirmation with what? A violation of our very same low, or a close below, or a trade below this very same low, if we're looking to continue moving to the downside. And then four is, if it happens that price stays below, we can still buy, we can still sell. Or if price trades below, or even though we don't have a break below that very same zone, we can still look to be bearish, right? So after sharing this around 2 p.m., 1400 p.m., you can clearly see that from this candlestick, we didn't really close below our what? Our lower low, right? But when you clearly understand your trading, your candlesticks, your structure, your candlesticks in your trading sessions, you can know that in most cases when something like this occurs, this is basically just a trap. Once price closes here, it confirms but doesn't confirm, but it's only based on the experiences that you have in the forex markets. How often do you execute, or how often do you stay on your charts to see what happens every time something like this occurs, right? So we can tell that this candlestick didn't really violate this very same lower low. But looking at the momentum, looking at the structure, and looking at our sessions and looking at our candlesticks, there were higher or greater chances that price might continue moving to the downside, following our what, following our structure, right? So when 1400 p.m. hit, the candlestick closed, and then 1500 p.m. hit, you can tell that price, and like just literally broke below that very same lower low. And with the break below that lower low, this is where we took what this is where we put our money to work. And it took this wonderful trade with a clean 30 pip target, and a clean 20 pip stop, right? So the equivalency of this trade, guys, was mainly based on, right, the perfect risk reward ratio that you have to use. One, it's high volatile. One, it's 1500 p.m. It's high volatile. Let's say like it's market open. The market tends to be spiky and tend to be volatile during those times. Two, many things can happen. With how price is looking and how price has been pushing, there were lower chances that price might still continue with greater moves to the downside. But at the same time, it's mainly based on where do you take your targets. From a 20 pip stop, we managed to get a 30 pip target. With that 30 pip target, this was what we were looking for, and this was what we have anticipated in the CAT Academy team. So, understanding the power of your risk reward ratio saves you from drawdown, saves you from inconsistent losses, and most of all saves you from taking L's day in day out even though you saw profits, right? Because many traders can see price moving in a one-to-one. They don't lock their trades, so they don't take most or major profits. They want to let it hit your 1 to 5, your 1 to 10, your 1 to 50, and at the end of the day, price reverses and takes them out. And when you look at this, you can clearly see that from the 30 pip target that we had, price started having some type of weakness, and what happened from there, price pushed to the upside. So we could have had a break-even day if I was literally looking for a 60 pip target, because this was a 60 pip target, a 1 to 3. But because of what? Because of your market open, because of your trading sessions, because of your candlesticks, because of your structure, and because of your momentum, that's when I anticipated that, you know what, guys, let's take this 30 pip and let's be out of the markets and let's show up tomorrow. And you look at it, that's how we took it. That's how it was. That's how it always has to be. You guys get that. So without further ado, I hope you enjoyed the video. I hope you share the video, and I hope to see you guys on our next video on Friday. Without further ado, this is your boy Harlem, King COT, and we're signing out.